Firstly, good afternoon, everybody. I'm delighted to see such a big participation in this webinar. On behalf of CPAI, that is Commodity Participants Association of India, and MCX, Multi Commodity Exchange of India Limited, I extend a hearty welcome to each one of you for having spared your time and come over here to attend this webinar. Now at MCX, it is our constant endeavor, it is our constant effort to touch base with all the stakeholders of the commodity derivatives market and explore the different problems and the prospective solutions to each of these problems on different aspects of the commodity markets. We also try and explore the potential of this market in multiple aspects. And one of the ways in which we do this is by way of independent research studies. Now, we have initiated several research studies on different aspects of the commodity derivatives market. And this webinar is actually to present before you the findings of one of the studies. We shall be holding more webinars to disseminate the findings of more studies in the days ahead. And we will definitely keep you all posted about it. This study that we are going to present today is titled, Why Commodities Should Be Included in an Investment Portfolio. This study was conducted by Professor Sony Thomas and Professor SSS Kumar from IIM Kozhikode. We are very happy that they have agreed to be present here today to finding their study findings. Before we get into the study findings, actually, with the presentation and a small panel discussion, I will request Mr. Rishi Nathani, Head of Business Development and Marketing, to deliver his inaugural address.
Thank you, Devajyoti. It's a pleasure to bring to you this webinar in association with our partner CPAI, which comprises of the members of MCX. So we are talking today about why should commodities be included in a portfolio. And let me just dwell very briefly on that. Today, whenever you talk about any asset class, generically you will find only few asset classes. Ideally, the most popular is equities, then you have fixed income, you have real estate, you will have currencies, you have insurance, and you also have commodities. Now, as you have a meal, and if you have, say, 4 items in your meal, and suddenly a 5th item is provided, the taste of that meal increases. Similarly, when you add commodities to your portfolio, the overall flavor of your portfolio also increases. Another advantage of adding commodities to your portfolio is that they are counter-cyclical to equities and fixed income in the long run. In the short run, like right now, because of the extreme global liquidity, everything is moving in one direction. But normally, if you see that when equities and bonds don't do so well, that is the time commodities will support your portfolio and will, increase the diversification and reduce the risk of your portfolio. So that is one of the reasons to include commodities in your portfolio. Another reason to add commodities to your portfolio is that commodities will always help your portfolio stay ahead of inflation. Because end of the day, inflation is nothing but increasing prices of goods and services. So if you add commodities to your portfolio, it is a great way of inflation proofing your portfolio. Third reason why you should add commodities to your portfolio is that, especially in the case of internationally referenced commodities, let us say gold, what happens is that while we are making money or trying to improve the value of our investments domestically, we see that the rupee is always depreciating against major global currencies. Now, when you take internationally referenced commodities like gold, you also get the benefit of currency hedge. Let's take an example that if the international price of gold is $1,800 an ounce and rupee is at 73, suppose the rupee falls to 75 without any change in the international price of gold, which stays at 1,800, still you will find that the price of gold ideally should be. So therefore, you will get an automatic inbuilt currency hedge without having to pay extra for it through an international referenced commodity. Also, commodity today, if you are thinking of buying equities or currencies, or equities or fixed income instruments, if you don't also buy it, there is no compulsion. It is that you want to invest your money. You can park your money elsewhere also. But in commodities, there is also a compulsion to invest in commodities, because today, whatever food you're eating, the clothes you're wearing, the place you're sitting in, everything around you, your entire life is surrounded by commodities. And commodities are the basis of any economic activity and the fuel for economic growth. So, end of the day, if you are looking at, if you believe in India, if you believe in global growth, if you believe in the India story, then commodities will always act as the underlying foundation for that growth. So therefore, it is very important to have commodities in your overall portfolio. So with this, I would not take much time and would give it back to Debo to invite Mr. Wadhwa to speak.
Thank you, Mr. Rishi. Now I welcome Narendra Wadhwa to please come and deliver the special address for today's event.
Thank you,
Mr. Narendra
Devojit.
Wadhwa is the President, CPEI. I will request all participants to please be in mute so that there is no disturbance.
Thank you, Devojit. Good evening, everyone. Rishiji, team, MCX, our eminent speaker for today, Professor Sony Thomas, Professor SS Kumar, respected members, आप सबका स्वागत है आज के वेबिनार में. I sincerely thank Rishiji and team MCX for associating with CPI for this webinar. Today's webinar is on commodities as an asset class and the opportunities ahead in these commodity sphere. CPI and MCX are continuously associating and conducting many joint programs like today we are doing. In coming months also, we will be doing more programs for members and again for new contracts and training for awareness of the commodities market. CPI is always committed to enhance the value of commodities market and working towards making it transparent and safe and vibrant. On behalf of CPI, I also thank everyone for attending today's program, the opportunities in commodities. See, we always used to speak about 5 trillion economy before this pandemic. So one of the studies by McKinsey says that 40% of this 5 trillion will come from the commodities market. So we have to ensure that these markets are vibrant. These markets gives you the opportunity to all the participants in the ecosystem of commodities. So as an asset class, definitely one important part which our WTM used to speak, what is required for development of these markets were 3 Ps. These 3 Ps was product, policies, and the policies and the products. So many products, policy, SEBI has taken various measures. So is our Ministry of Finance to ensure that there is a healthy ecosystem wherein people can participate in this commodity sphere. Then there are products, indices, options, and many new contracts like weather, trade, which are being discussed in various committees of the SEBI are coming, which will offer various different opportunities in the commodities market. Then there were participants, AIF, mutual funds, and PMS were allowed in commodities. Investor can participate through these modes, and definitely there is an opportunity. Especially if you listen it from the academia, they give you different perspective. Today we have eminent speakers from IIM Kozhikode, so we'll be listening to them. So I'll just briefly say that what is basics of commodities in a portfolio. The most important thing to remember when considering commodity in your portfolio is that there is a big difference between investing and then speculating in them. Some investors feel that you have to open commodity account and trade futures contract if you want to invest in commodity. That was the traditional path until a wide range of different financial commodity instruments came into market. So these instruments are, if you can buy it directly from the market and keep on investing in that. Other modes are mutual funds, ETFs, which are there and going to come in near future. So huge opportunity in markets, in the commodities market. I'll not take much time because we have eminent speakers today. I once again thank Rishiji MCX team for collaborating with CPI, and let us listen to these eminent speakers today. Thank you and have a safe and healthy, stay safe and be healthy. Thank you. Thank you.
Thank you, sir. Thank you. Thank you, Mr. Wadhwa. Without much ado, let us start the presentation. And I request Professor Sony Thomas and Professor Kumar to please share the presentation and enlighten us about what they have found about why commodities should be included in an investment portfolio. Professor Thomas and Professor Kumar, please.
Yeah, thank you, Mr. Debajyoti. Good evening, all the participants. So this is a brief presentation on the research we did for MCX. So just to start with the background of the study. So we started from an investor angle. So what are the options available for a retail investor in India currently, especially in terms of financial assets? And the second most important point is the risk return dynamics of those assets. Certain assets are giving high returns, certain assets are giving low returns at a lower risk. And another aspect is diversification. So what is the level of diversification these assets are providing? So if you look at the Indian context, we have these three broad category of assets which people are investing. I would put it as equity, debt, and gold. And there are various types of equity instruments, various types of debt instruments. Similar is the case with gold. Let us start with equity, one of the popular form of investment in India. So people invest in various forms and they diversify across equity, across sectors, across large cap, mid cap, small cap equity. Or now there are options for diversifying it across different countries. So we have international ETFs available in India. Then another popular form of investment is debt. People invest in fixed deposits or bonds or mutual fund, various types of debt mutual funds and things like that. Third major category of investment in India is gold. We know that there are various forms of gold currently available. People can invest in the form of physical gold, gold ETF, sovereign gold bonds, various possibilities. MCX offering futures on gold. Now, the question is, what are the other options available? So with these options are more or less exhausted. So what are the other options available to an investor? And how that is beneficial to an investor from a risk-adjusted return perspective. So if the risk is low and the return is low, so that is one of the major problems people like retail investors are facing in India. So we explored the possibility of including commodities into these kind of portfolios, equity, debt, and gold portfolio, or in isolation also. Somebody will be holding only a debt portfolio. How commodities are useful? In each of these cases, a combination of equity, debt, and gold with commodities. Of course, gold is one type of commodity. How relevant is gold in this portfolio? So that is also a point of study in our project. And if you look at the commodities that are available apart from gold, so there are various types of commodities. I'll get into that in a short while. So before that, let us take a look at the returns. See, when we see these kind of studies, people talk about the diversification possibility across various assets. And let us individually take a look at these popular assets, which people currently investing in India. If you look at the risk and returns, you can see bond returns and equity we have categorized into three. Large cap equity, mid cap equity, foreign equity, and gold also. So these are proxied using appropriate relevant indices. Bond is proxied. We have taken the risk-free asset, Nifty 10-year government yield. Gold price is proxied by using the spot price of gold. And large cap equity is proxied by using Nifty index. Mid cap proxied using mid cap 50 index. Foreign equity proxied using N100 ETF. And gold, as I mentioned, in the spot returns. And please take a look at the risk and return here. So as it is evident, bond is having the lowest risk and lowest return, but the Sharpe's ratio is very high because this is what investors are looking at. So Sharpe's ratio is basically risk-adjusted returns. In other words, the returns generated by your asset for each unit of risk you are taking. So this is a very, very important measure. So if you look in terms of that, bond is attractive in terms of risk-return profile. Please take a note of this figure, Sharpe's ratio of 1.4, and risk return. Basically, you are getting 7% return at 5% risk. And this study, we have included the data from the last 10 years. It is not for the last 1 year or so. The advantage of doing that is, so basically it captures the entire business cycle. And this is a period when commodities are giving some average returns only. So let us look at that kind of scenario and how commodities performed vis-a-vis the other popular assets. So when I say that, I'm talking about gold also. So how this could help in enhancing the risk-adjusted returns of your portfolio. That's what investors are looking at. So what is that proportion? So now the approach currently followed is some heuristics. Basically, people say that they put 5%, 10%, 15% in gold. Similar is the case with bond and equity. So people who are older, right, they put more in gold. People who are younger, they put more in equity, things like that. So a lot of these heuristics are in play. In our study, we take a look at all these things, what happens with heuristics and what happens with an ideal risk-adjusted return scenario. So how the risk-return characteristics of the existing assets in India could be improved by including commodities, various commodities that are available. So if you look at MCX, they are providing various options of trading in equity. So it is broadly divided into various categories: bullion, base metals, energy, and agri commodities. But we have included only bullion, base metals, energy. If you are including some of these commodities with our existing portfolio of bond and equity, how it is going to help an investor, both for enhancing the returns and reduction of risk. So these two are very, very important characteristics. Some of the metals or some of the metals category items or energy or bullion, they may not be having very high trading volume, but we consider all those things, how this would have performed over the last 10 years, so that we can draw necessary meaningful inputs for our future investment purposes. So entire thing is based on last 10 years of data. So how this performs. So it is not based on 1 year of data. So how this is actually helping for enhancing the risk-adjusted returns. So now, if you ask me what is the key research question, so we have given everything in detail in our research report. So here we are focusing on the key aspect. So if you ask me what is the key research question, so as I've explained, it is basically to explore the diversification possibilities of selected commodities that are available to an investor in India through commodity futures in bullion, base metal, and energy category in a diversified portfolio of stocks and bonds. So if you ask me what is the typical methodology which is followed, first people will calculate a correlation matrix between the returns of all these assets. So we have not put any constraint at the start. So we have included all the possible commodities which could be included purely from a risk-adjusted perspective. See, one methodology is that using some heuristics, you can put 5%, 10% gold in your portfolio. What is the other methodology? Other methodology, so we can study from that angle also. Suppose we include all these assets along with the stocks and bonds. What proportion of commodity would remain in that portfolio which is having the best risk-adjusted returns? See, normally we know that whenever we create any portfolio, this correlation is a very, very important measurement. What is the significance of correlation? Most of the people will be knowing. So correlation, low correlation denotes very good diversification. So normally correlation varies, actually correlation varies between +1 and -1. So if the correlation value is high, that denotes lower diversification. If the correlation value is low, that denotes higher diversification. So I marked, so for each commodity, where you are getting the lowest diversification, I have marked red, and where you are getting the best diversification, I have marked green. So you can see for each of these categories, you can see that, say for example, if you take Nifty, you can see that you are getting the best diversification from gold when I look into the last 10 years of data. So not only gold, in fact, all the commodities, you have a correlation towards the lower side. So when you compare with other equity instruments, say for example, mid cap, so that's having a high correlation, which basically means lower diversification. So all these instruments, Nifty, mid cap, and bond, they have very, very low, or they are having the very low value of correlation with gold, which basically shows that this is providing very good investment opportunity and diversification potential. And if you look at an index like NASDAQ, so this is a foreign ETF available in India. So there also, you can see that all these commodities are having very low values of correlation, which basically denotes very high diversification potential. So even if you look at all these commodities, they have the lowest correlation with bond and equity, so which basically augurs well for the prospects of including commodity in an investment portfolio. So this is one aspect. So correlation basically denotes only diversification, but we cannot focus only on diversification by taking a hit on the returns. So returns are also very, very important. So how we can take the best advantage of this diversification element of commodities using these commodities. So that is a key thing which we are going to show you from our research study. So if you ask me about the methodology, as I mentioned, there are two ways in which you can study all these things. One is that you can use the popular heuristics. You can include a certain percentage of commodities in your portfolio and see how it is performing. The other way, if you look at the actual portfolio management studies, you can see that they adopt this Markowitz framework, which basically talks about maximizing returns by minimizing the risk. So basically, we start with a portfolio which will be having the lowest risks. So suppose I include all equity, debt, and all these commodities. I will not put any constraints. So which type of portfolio will give you a portfolio with highest returns at the lowest level of risk? So that methodology we have adopted. And for investors who are willing to take higher amount of risk, they can take higher risk and they will eventually get higher returns also. So Markowitz basically focus on the lowest risk portfolio by maximizing the returns. And when you are increasing your returns, you are going to get higher returns. So these two approaches we have adopted. One is heuristics, the other one is Markowitz framework. And we have not put any constraint in terms of this much percentage of commodity or this much percentage of equity and debt. What is the advantage of that? This will clearly tell you in the last 10 years, what type of portfolio would have given the best risk-adjusted returns. So rather than just focusing on some heuristics, that is a better methodology. So I'm not telling that we'll be able to implement that 100%, but this will give you an idea about the significance of adding commodity to a portfolio of stocks and bonds. So we have generated hundreds of portfolios. I've already shown in my presentation that the asset which is having the highest or the best risk-adjusted return is the Government of India bond, which is giving a Sharpe's ratio of 1.4. And we have generated portfolios by keeping this risk-return profile in mind. And we have identified those portfolios which are having a Sharpe's ratio greater than 1.4. So currently the best asset is giving risk-adjusted ratio of Sharpe's ratio of 1.4. So we have created a portfolio of stocks, bonds, and commodities. And we have not put any constraint there using the last 10 years of data. And what type of profile is there for those portfolios which are giving a Sharpe ratio of more than 1.4, so which is basically the best risk-adjusted scenario. So let us see the main characteristics of those portfolios. We have generated hundreds of optimized portfolios, which are giving this risk-adjusted return of higher than 1.4%. So which is the risk-adjusted return of Government of India bonds currently. So this is the main feature of that portfolio. Hundreds of portfolios which we have created. A lot of portfolios are there with Sharpe ratio greater than 1.5. And please note the point: this 1.5 is Sharpe ratio of 1.5 is higher than the Sharpe ratio of Government of India bonds also. So if you look at the mandatory part, so what is the mandatory requirement of that kind of portfolio, which is giving the best risk-adjusted returns? Bond is a mandatory component, and those portfolios have weights ranging between 5% to 80% of bond. See, people who are taking lower levels of risk, they'll be going for more bond. People who are taking higher levels of risk, they'll be going more for equity component. And gold is also a mandatory component. So gold is a very popular commodity. So that is a mandatory component. All these portfolios which are having high risk-adjusted returns, they have this weightage of gold, which is a mandatory requirement. Natural gas weightage is also a mandatory requirement. And there is a mandatory weightage from equity, any type of equity, Nifty, mid-cap, or N100, foreign equity. Again, if you are going for higher levels of return, the last 10 years, naturally the proportion of NASDAQ would be higher. If you are going for lower levels of risk in equity, Nifty, definitely Nifty will be there. So we have given the range of weights which were available for the portfolios with best risk-adjusted returns. In fact, risk-adjusted returns better than the Government of India bonds. And the other last mandatory category, base metal. See, one of these assets is a mandatory requirement for creating the best portfolios. So either aluminum or zinc. So going forward, it may be some other commodity or maybe aluminum and zinc itself. But these are mandatory requirements. So we cannot create a portfolio with the lowest level of risk without ignoring gold or energy or precious metal. So that is very, very evident from our study. And due to the lack of time, we cannot show you the entire results, but we would like to show you a sample portfolio, how it would look like. So how these portfolios would look like. Say, for example, the lowest risk portfolio available. What is the weightage of all these assets? So without putting any constraints, what are the weightage of these assets? And look at this risk here. It is 3.86%, which is almost half of that of the Government of India bonds. And in that portfolio, you can see that naturally bond will be having a higher weightage. But look at this, gold is there, aluminum is there. Naturally, again, aluminum is one of the commodities which is having lower levels of risk. And significant aluminum component, 5%, and risk is 3.8%. And the return is higher than the Government of India bonds. So just to show you that. And Sharpe ratio is 2.3, which is significantly higher than the asset with best risk-adjusted returns. And I would like to also show somebody who wants to simply focus on increasing the Sharpe ratio, highest risk-adjusted return, the portfolio with highest risk-adjusted returns. What is the profile of that? So there also you can see all these commodities coming in. So without these commodities, you will not be able to get into that best risk-adjusted scenario. So diversification is actually working in favor of commodities. So without getting into commodities, will not be able to attain that portfolio with best risk-adjusted returns. And please remember this fact that this is a time period when commodities give average returns. Things are going to change now. So people are talking about commodity boom and all. So things could get changed. So let me quickly summarize. So most important finding, if you ask me what is the most important finding from this study, it is the importance of commodity And I've demonstrated that with some data. So commodities are absolutely, all these commodities, base metal, bullion, as well as energy commodities are absolutely essential if you want to create a portfolio with best risk-adjusted returns. So that is very, very evident. Even if you look at some of the heuristics, right? 5%, 10% rule. So people put money in gold like that. So all those cases, there is a definite amount of diversification which is happening. So that is very, very evident from the study. Now, a few recommendations also we want to highlight here. One of the major important recommendation is it's already happening. It's a financialization of commodities. So if you look at retail investors, these commodities are not very conducive for retail investors to get accustomed to, even though there are a lot of steps specifically from MCX and SEBI to make it popular. So if you look at MCX futures, they have introduced MCX gold petal contracts and Guinea contracts, which made it reasonably very popular among retail investors also. But there are complications like the mark-to-market margin and things like that. So maybe we can take more steps for making these commodities attractive to the retail investors. Maybe commodity ETFs. They have introduced commodity indices. So we can think about commodity indices and stuff like that. So more and more innovative products which will help investors to take an exposure to commodity, that is essential. So when I talk about financialization of commodities, there are two things. One is new products, other one is regulation. So appropriate regulations. So a lot of regulatory changes took place. So if you look at the recent regulations, mutual funds are allowed to invest in commodity markets. Similarly, banking subsidiaries are allowed to invest in commodity markets. Options are allowed in commodity markets. So all these kind of regulations are happening. So appropriate regulatory changes could be made so that we can make it more popular. So financialization of commodities, basically in terms of innovative products and in terms of regulations. So that is one of the key things which is required for the popularization of commodities. Next point, which is very, very important point. So I just mentioned about commodity super cycles. So every now and then, if you look at the history of financial assets, we experience commodity super cycle. So the last commodity cycle, super cycle, was regarding this Chinese boom, which basically ended by global financial crisis. And the time period which we took for the study was basically was not a very booming period for commodities. So in those time period, we got this kind of profile for commodities. So if you look at the current situation, people are talking about renewable energy, energy efficiency and resource scarcity. And a lot of these traditional commodities, they play a very, very important role here. So if you look at commodities like copper or silver, see, they are going to get used heavily here, even aluminum for that matter. So if you want to increase the fuel efficiency of the vehicle, you have to use more aluminum. Or metals like zinc. So they are going to have a higher demand going forward. So that is an expectation. So these type of commodities, appropriate innovation should happen in these type of commodities also, so that investors can generate this additional alpha. And there are clear-cut diversification benefits from all these commodities. Next major recommendation is, now steps are taken for establishing this spot electronic trading platform for commodities, or it could be added to exchanges like MCX, because both spot and derivatives, well-developed spot and derivatives markets are absolutely essential for improvisation of the market. So we have given detailed recommendation. You can take a look at the report. I've just mentioned only a few important ones. So you can take a look at the detailed report. It is published on the MCX website. So where we have a lot of data on this analysis and policy recommendations. Okay, so that's about it from our side. So at this juncture, I would like to specifically thank MCX for providing support to our research project, and Commodity Participants Association of India for providing us with a platform for showcasing our research here. Thank you.
Thank you, Professor Thomas, for this wonderful presentation. So there are so many questions that I think a lot of us would want to ask. So I'll kind of ask, like to just for the clarification purpose, and also to get more insights into what you've just presented. Just a few questions. So first is in the report that we have seen, much of the analysis that you have done for the commodity markets is using the spot prices data. How do you think the results or the conclusions would change if we were to consider the futures prices? Because if you use futures prices, there would be obviously the element of the roll returns, and if we are taking a long period, like a 10-year period, the roll returns could be a little significant. So do you think the results would change if you were to take futures prices data rather than spot prices?
All right, good evening, everyone. I'm Kumar here. So, Dr. Devajyoti, your question is very pertinent. Generally, it is defined excess returns is equal to the spot returns plus the roll returns. And roll returns is a function of convenience yield, storage cost, and interest costs. So it can be positive or negative. And the reason for using spot prices in our study is because of some data-related constraints. But nevertheless, we are pretty sure that our results and inferences will hold true even if we consider the future returns, because there are a couple of studies in the US markets which have actually showed that when the spot prices are replaced with the futures, actually the Sharpe ratios have improved only for the portfolios. Okay, so I don't see any reason why the same inference will not hold true in India. So we are of the strong opinion that they will only show improvement, but they will not show any deterioration.
Right, sir. Sir, the other question I had was, there are several mentions several times in the report, and even in today's presentation, there have been mentions of retail participation. Now, retail participation, as we all know, not only in commodity markets, in any market, is one of the better ways of enhancing retail participation is through the mutual fund routes. Now, in commodity markets, the mutual funds have been allowed. It's been a few years since mutual funds have been allowed, and there are mutual funds which have entered this space. However, we do not see a lot of traction. We do not see a huge amount of enthusiasm among mutual funds in this space. The same is in the case of other funds like the alternative investment funds. So I think there are a lot of fund managers in this audience. So what message would you want to give to the fund managers?
There are two parts to your question. Let me first take up the first part, that is retail participation. Certainly, retail participation will happen with the championing of this asset class by the mutual funds. Give a small example. A few years back, not even we don't have too many mutual funds who are offering international opportunities fund. Maybe you can remember one from Motilal Oswal, the other one from Franklin Templeton. Rest, it's not such a big thing. But now you have almost 40 to 50 mutual funds offering international investing opportunities, and more are coming every month. So some kind of mutual funds, Sahi kind of advertising from the AMFI is required for championing this thing. And when it comes to the problem from the fund houses point, okay, SEBI has to make a few changes. For example, a fund cannot hold the commodity for longer than 1 month. So there are some kind of restrictions. Okay, so they have to take compulsorily physical delivery. And remember, mutual funds are an investment vehicle. They are not going to open up warehouses, etc., etc. So some kind of ironing up of the frictions is required on the part of the regulator also. So it has to be a collective and a joint effort, regulator, fund management industry, and then possibly I think we can see a lot of participation from the retail investors. Someone has to evangelize this from the fund house.
Yeah, just to add one more point, and if you look at the performance of commodities also, so if you look at all these commodities, right, maybe except gold, the performance is also pretty muted. But now we are seeing a lot of silver lining, right? There are a lot of themes which are emerging, which I mentioned in my presentation. And in all these themes, right, a lot of these commodities are going to be a very, very key ingredient. So we can see, or we can expect higher returns from commodities. People call it as, we don't know yet whether we can call it as commodity super cycle. So a lot of these commodities, there is a high expectation that they are in a up move. So that also will help in earning additional alpha returns. So it depends on that cycle. So we may be at a right point now where fund managers would find it very interesting to include this also in their portfolio. And all our results were in that time period when these were performing pretty average, a lot of these commodities. So in that circumstance, they were giving these type of results. As and when things improve, definitely the prospects are going to improve.
So you mean to say there's a combination of some regulatory changes as well as a little bit of a marketing by the fund houses,
right?
More in the direction of risk adjusted returns,
right,
rather than pure returns that you have just mentioned in the presentation. Okay. So, sir, another, I mean, again, coming to back to the recommendations that you have made, there's a separate chapter in your report on recommendations. So there are several recommendations you have made. So I don't think we have the time to go through all of these. If you were to select one recommendation for the exchanges and one recommendation for the regulator, the most important one that you would consider, worthwhile for pursuing, one for the exchange and one for the regulator, what would you really make the recommendation for?
It's a lot more easier for me to recommend for exchange. For the exchange, certainly, I think it's time for some kind of ETFs on the commodity index. MCX has a very robust composite index which was built. So I think that's the best way to invest for the retailers. So that's one thing which has to be looked at by the exchange. And from the regulator's point of view, although politically incorrect to say, but the some kind of relook at the peak margin, which has actually blown a lot of volume, may be looked at. Okay, and some restrictions on the mutual funds in terms of holding the physical goods can also be looked at by the regulator.
Right. I think there's a question. In fact, I also wanted to ask you, because this is something we have introduced less than a year back, which is about the commodity indices. So we have launched, as you might be aware, an index on bullion and another index on base metals, and they're doing fairly well. 2 days back, our metal index had the highest volume, since the time it was launched in October 2020. Now, what's your take on asking all types of participants, particularly again the retail participants, to go to the invest in commodities using the index route? Do you think it's the most feasible and the most desirable, or are there certain certain things that the investor should bear in mind while investing via the index route?
I think that's the best way, because we have not included in the report, but we don't mind sharing it. One of the aspects that we have looked at is the correlation between the index with the inflation.
Okay.
See, when the inflation is increasing, both your, I'm talking about the expected inflation. The expected inflation that is built into the premiums will automatically help both bond yields to go up, and the stock returns also will be moving favorably. But when you look at the unexpected inflation, unanticipated inflation, okay, so both bonds and the stocks will take a hit on the part of the unanticipated inflation. But it is only the commodity index which is strongly correlated with the inflation. This is what we have seen. Not only anticipated, but even the unanticipated inflation, which we have taken it as rate of change in the rate of inflation itself. So that was very, very strongly correlated with the composite index of MCX. So that actually tells us that if you are looking at hedging from unanticipated changes in the prices, okay, I think commodity index is the way to go.
Absolutely.
Maybe Sony, if you want to add.
Yeah, I think you have summarized it.
Yeah.
Sir, there was another question about investing in commodities, like through the route of the stocks, the equity of the commodity exposed companies. A lot of people traditionally have been doing this. So if they feel that the metals are going to go up, what they would do is buy the shares, the stocks of the metal companies. So we have metal index also in the equity space as well. And in fact, I think there has been some studies in some developed countries, I think it's in US, which has shown that if you are investing in commodities, either by directly investing in the commodities or by investing in the stocks of these commodity producing companies, your returns over the long period are tending to be more or less comparable. So do you think it holds for a country like India, or do you think it is like this is the best way of going about things, or what's your take on this?
Maybe I think it's an opinion from our side, because this is not part of research, but we are of the opinion that investing in commodities is a pure play. If you are looking at actually a pure play bet on the commodities, I think you have to go through the commodities directly, not through the companies which are in the commodities business. Because when you are investing in companies with commodities business, you are exposing yourself to the company specific risk also, which is absent if you are taking the commodities route. See, for example, some copper company which is facing difficulties in Tamil Nadu, okay, for starting its plant. So if you are investing in a company like that, okay, you are exposing to that company specific risk. That risk is not there for other commodities. So if you are looking at bet purely on commodity returns, okay, I think this is the best way.
And this passive investing is becoming a very important thing, right? A lot of these people prefer to do passive investing. Most of the people say they don't have skills to pick up a stock or a mutual fund. So they employ these passive strategies. So if you are really thinking in terms of stocks, it will be difficult for a lot of these investors. And again, picking a commodity stock is even more difficult when we compare with other stocks. Picking a commodity stock is even more difficult. So as Professor Kumar was telling, if you want a pure commodity play, maybe from a passive angle also, definitely we need to get into commodity through one of these routes, not through stocks.
Right, sir. Sir, I have I went through the report and I couldn't help notice the emphasis that you have given in multiple places on adopting a tactical approach to asset allocation. I think you have written, and I'm quoting, we need to adopt a tactical approach of asset allocation so that diversification benefits can be maximum extracted. So when you say of adopting tactical approach to asset allocation, do you recommend frequent churning of the portfolio? And if that is the case, then how do you recommend that a retail investor will get the benefit, who probably will not be able to do that kind of a churning as much as an institutional participant will be able to do?
Yeah, if you look at the entire data presented in the report, it was written from a retail investor angle.
Right.
So all these results which you have seen, so all those results were with the assumption that there is no churning of the portfolio. So what we are suggesting is that if you are able to do that, maybe a retail investor may not be able to do that. Maybe institutional players will be able to do that. So like a fund manager in an equity mutual fund adjusting the weights of various stocks in his or her portfolio, if you are able to do that, actually you can get into much significant alpha returns, additional returns. And retail investor, maybe through the help of these institutions, maybe if you have products like that, they can do that. So in our report, basically we said that even if you don't do that, this is what you are going to get. So ours is a base case scenario. Things are going to get improved only. So if you are able to do that, naturally you get into a much better return than what you have seen in the report. And maybe as and when these commodity markets evolve, right, we have new professionals like commodity trading advisors. So they can provide help. Even if a retail industry is trying to do that, they may be able to provide help how to adjust their portfolio. But as of now, even if they don't do that, so this is what you get if you look at the last 10 years of data.
Sure. So again, your recommendation of adopting a tactical approach, leads me to another question, which is directly related to what Mr. Nathani was saying in his inaugural address, which is the fact that arising from the fact that non-agricultural commodity prices in India are more or less a reflection of global prices and the exchange rate. Both global prices of the commodities at the global level and the exchange rate. So given that, do you see a tactical opportunity of using these commodity futures, particularly non-agriculture commodity futures and currency futures together in tandem to have a de facto position in global commodity pricing? Is there an opportunity you see here?
I mean, certainly it is having more ammunition for fighting the market risks. Okay, so you have a very active currency futures and then an active commodity futures market is kind of a double whammy. Of course, it depends on whether you are a producer or a consumer. Okay, accordingly, you may have to take your position. But having both the markets with very good liquidity, okay, is a blessing for a net importer like India, which imports most of the commodities. So we can fight the price risk better with both the kind of derivatives.
All right, sir. I have a specific question on gold. Gold, you have mentioned gold as a quote-unquote compulsory, inclusion in a portfolio. Now, when you talk of gold, we have so many different, variants in terms of participation in the gold market. We have physical gold, we have ETFs, we have sovereign gold bonds, options. Now we have index on bullion, and very soon we are going to have a spot exchange for gold. Now all of these are happening. Amongst all of these, what is your take on use of gold futures among so many other instruments?
That is actually a tough question even for also as an investor, because each of these products have come with their own baggage. They differ in terms of liquidity, they differ in terms of security, storage costs, active management skills, so on and so forth. So they all come with their own pros and cons. But since you are asking me specifically about gold futures, I think as the innovations are coming up, more and more innovations are coming up, we think that there will be more popularity for these gold futures, especially the two very impressive characteristics are you can convert it into a demat form, take delivery in demat form or physical form, and then reconvert it. Okay, these are all great innovations, and also a secondary market, okay, which actually is available late in the night, is a big blessing for many people. Most people may be busy with their office hours, so to keep track of their positions, it's a lot more convenient of the office hours. So that's one big advantage gold futures is offering. And then just imagine the kind of credibility this market inspires because of the regulatory oversight. This market is regulated by SEBI, so that will inspire a lot of confidence in the traders. So these are certainly pluses on the point of view of gold futures.
So I take from your last point that you are hopeful of a great success of the forthcoming spot exchange for gold, which is under again the regulatory oversight of a autonomous regulator.
Correct.
Because both the spot and derivatives, right, they have to work in tandem. So if they work in tandem, there will be a lot of additional opportunities for hedging and stuff, or arbitrage also for that matter.
Right.
So there are a lot more avenues. Maybe we can put in the category of innovations again.
Okay.
And actually these innovations combined with these regulations, right, will ultimately it is going to provide. So this is our expectation. for the right reasons. So we are hoping that this will provide more liquidity. So once more liquidity is there, that will lead to a lot of other positive things, both for institutions and various players in the market.
Yes. I think we have time for that much of panel discussion. Sir, Professor Thomas and Professor Kumar, I can't thank you enough on behalf of CPI and MCX both. Heartfelt thanks to both of you for firstly for conducting this study, which was, I think, very timely, and agreeing to be here today and addressing all of us. We had 100+ participants at one point of time, and I think all of us have gained a lot from your presentation and some answering some of the queries. It was really, really enlightening. So with that, we end today this session. And before I end, again, very heartfelt thanks to CPAI, to my colleagues at MCX, and everybody present here today for taking your time out. If you have any questions on any aspect of this study, or even in the future, we are going to hold this kind of webinars for other studies, please drop us a mail at research@mcxindia.com. It will directly reach our team.
Debo, just a point. If we can, I'd request Mr. Wadhwa to share this report with their members so that they can also circulate it to their clients.
Right.
So, and also use it within their research desks to highlight, that how important it is to have commodities in a portfolio.
Absolutely.
Definitely, Rishiji will definitely distribute.
I will send it to you, Wadhwa sir, and this for everybody present here. This report is on the MCX website. Under the education section, you will find a subsection called papers and reports. So this report is already there. Please download it and read it. And if you have any question, please don't feel free. Don't hesitate to write to us. Please feel free to write to us on any aspect of the report or anything about the findings or the recommendations. So thank you again, everybody, and have a great evening and a great weekend.
Thank you.
Thank you.
Thank you.
Thank you all. Thank you.